Welcome to Straight Talk Wealth with your experts in all aspects of wealth accumulation, preservation, and income guaranteed to last a lifetime. And now, your host of Straight Talk Wealth, Bruce Whitey.
Hi friends, Bruce Whitey here, host of Straight Talk Wealth Radio. Look, I got a business to run. I got clients to service. I wish I could give you the slickest, most polished videos, and I can't. This is an emergency. I want to get the story to you, and I want to tell you how, for decades, I learned my lesson in the tech bubble. I learned that when you think everything's going to go up forever, it doesn't. And that when you go out and you're a young kid in the financial service industry and you've talked to all your friends and family and you've gotten them to give you their accounts, what it feels like to lose a lot of people's money that you have to look in the face the next day and say, I thought it was going to go on forever. So we learned it in the tech bubble. I kept people safe from the real estate bubble. We got them ups when the market was up, and we didn't have the downs when it went down. And I want to tell you today that if you're getting close to retirement, you can't afford this other bubble again. And while there's a chance to save, get some blood off the plate, while there's a chance to go back up when the market goes up, I better talk to you right now about how we keep people safe. First of all, let's just talk about what is going on right now as we speak. And you may see this video later and it might be over. So I want to take a look at what's happening right now with the story about the stock market and what was going to happen sooner or later. And I want to talk to you about alternatives. I want to talk to you about at what age can you no longer afford this risk? What do you think is going on with people? Right now, they're 64 and a half and maybe looking at 20 to 30% losses in their portfolio 6 months before they're going to retire. This is no joke to leave yourself open to thinking that this kind of ecstasy could go on forever. All ecstasy comes to an end, okay? We've got a few natural examples of that. This is a financial one. So I want to look at what's going on in these markets right now, and I'm going to give you some solutions. And by the end of this video, I'm going to give you some actions you can take to get able to grow when this comes back out of the bottom and not have further losses ever again, particularly if you're getting to an age that's close to retirement. Wish I had great videos, slick and polished. I don't. I got clients to see. I'm just trying to get this done and get it out to you.
At the desk by Yahoo Finance's Brian Sozzi, just in time, Soz, to come in and give us a little kick save here on what's going on in this market. Your head's spinning.
I mean, I'm superhuman, but even I can't save this market, guys. This is dreadful, and this is the next shoe that a lot of people in Wall Street have been talking about the past day and a half that might drop. This is institutional selling. I think what you saw Monday, Tuesday, and Wednesday, a lot of the momentum trades getting sold out. This is institutions, long-term minded investors saying, hey, you know what? We're all worried about the coronavirus in a big way, fundamentally altering how companies do business this year.
We're about 30 seconds away from the closing bell. Can't come fast enough for people watching. The Dow here falling repeatedly. We're hitting new lows for the session. Below 25,800 right now. Microsoft leading the Dow lower. Microsoft is off almost $12, 7%.
Some years that's all you get.
That's going to be the bell. You're looking at live pictures at the New York Stock Exchange and the NASDAQ market site. Again, we are looking at big losses here across the board, accelerating into the close.
Oh, we lost 5% off our stock price the day that we opened. A lot of smiles going on in that room.
There you have it. It has been quite a week. We have another 1,000-point move lower on the Dow. But these are, just check, forget the numbers and look at the percentages here in one day, off more than 4% for the Dow, the NASDAQ, and the S&P. If you want to go into individual names that we have been riding high on here, there is carnage basically everywhere.
And at one point, Miles, I'll toss this over to you. What point does the Fed come in here? Because I think they blew some of the community.
Look, I'm telling you, it is time to protect a portion of your retirement. This doesn't happen. It's not happening to our clients. I'm not personally concerned about it because I'm not in that free fall. So I want to talk to you. Now, we've gone over this for years. This is what we've been doing for decades. But I'm going to go over it one more time because I want you to understand the viability of what's called a fixed index strategy. Fixed means it doesn't go down. Index means It is tied to the index. Your gains are tied to the index. And by the end of this video, I'm going to give you some really good stuff you can call in for and get some freebies from us that'll help educate you on this. Let's just talk about that real quick. By the end of the video, I'm going to tell you how to get this report called Inflation or Deflation, America's Monetary System in Crisis and How to Plan for it. Now, I wrote it about 5 years ago, but it is a really good look at what happens in these kinds of crashes. Are they inflationary, deflationary? What causes this? And what are the assets that correlate to these different moves in the economy? I'm talking the major moves that people are very, very mistaken on. And by the way, it's chock full of pictures. You could, a high school sophomore could understand the content of this book, Inflation, Deflation, America's Monetary System in Crisis and How to Plan for it. And I'm also going to, by the end of the video, show you how to get this video, this CD of a 1-hour discussion I had with Harry S. Dent on the great gold bust ahead. Because this is going to talk about that bust is not, that gold is going to be not going to be a refuge. It is going to not respond as the savior of these markets. It goes down. In fact, right now there's an article on New York Times that was about the fact that gold's going down in this. So we'll talk about the ups and downs of gold in this CD. You can pop it in your car. We'll have that for free at the end of this video. It's just a few minutes. I want to take really quickly to help you understand why fixed index strategies can get you great gains in the good years and never suffer these backward movements and why it's so important. So it's time to protect a portion of your retirement. So this is a great, great little one-page flyer. That is from the Allianz company. I think they're like the largest insurer in the planet. And I'll include this when you call. When you respond to our offer at the end, I'll make sure you get a copy of this. But I just want you to look at this real quick. This is an interesting story. What does it take to come back from that? Here you'll see, if you lose 10% and you get 6% a year, every year thereafter, to just get back to where you lost 10%. To just get back to where you lost 10%, it's going to take you 1.8 years. So that means you lose 10%, and if the market comes back at 6, you're down for 1.8 years from where you left off. If it comes back at 8%, you're off for 1.4 years to come back. You go down 10%, and 8% market responds, it'll take you 1.4 years to get back. But this is more real. This is more serious. Let's say that you've lost 30% in a down market, and that market comes back 8% a year consistently. You're not going to be recovered for 4.6 years. Now, the lesson of this is if you're young, who cares? If you're young, you got plenty of time to let this come back. But if you're planning on retiring 6 months from now, a year from now, what are you doing leaving yourself in a position that you can lose 30%? That might take almost 5 years to come back. And I saw this in 2008. People came into my office and they knew right then and there that they had just set their retirement back 5 years by being fully exposed to this risk. So I want to talk about fixed index strategies. The basis of fixed index strategies is that when the markets go up, you're going to get a portion of the market, a share of it, not all of it. When the markets go down, you're not going to fall. You're going to lock in each year what you actually made. And then when the market goes up, you'll go up again, but from where you left off. So I want to visually show this to you. This is just conceptual. They're old slideshows. I don't have all my disclaimers on it. It's just general education purposes, but I want you to see this in action of how it works. So let's just say you have a regular market that's going up and down. Here you have $100,000 and over 5 years it rises to 230,000, 240,000, whatever you see on this chart here. And then it falls. It falls to 152, 168. This came from some stats. I can't remember. It's several years old, and I pulled up some PowerPoints. Instead of making new ones, I pulled some up to do this presentation. 152, 168. Then the market comes back and it reaches 238, 346. That's a very typical market, very typical of what we might be seeing right now if it's been rising for so many years, falls for a couple of years. I mean, this can be very typical. All right, so what happens on a fixed index strategy is this. You're going to get a portion of the index value, a portion of the gains. So in the years when this grew to $240,000, you probably grew to 200. You didn't get all of it on the growth. But when the market fell, when the market collapsed, you held. You held steady. In some cases, I think this was designed with a 1% floor. Like you could never make less than 1%. We don't see those so much anymore. And by the way, these aren't even as good as they used to be. If you're interested, you better act now, because when interest rates fall, it hurts these. They don't perform as well. We can't build them as strong as we used to, but they're still a real refuge if you're getting close to retirement. But the point is, you don't fall when the market fell. So then you go back up, and if you can climb, again, just a portion, you wind up ahead. When the market fell, this guy stayed at 189,263. And when it climbed from 189,263, not from the bottom. It didn't climb as much, but it still winds up ahead of the market after a dip. That's the lesson to be learned in this. That's your opportunity. This is another way of looking at it, the advantage of annual lock-in. This is where you're locking those gains in each year. Whatever you made this year, it can't be taken away. It locks in. Again, this is a 1% floor. I don't think we see these anymore, but it shows you the dynamic of what occurs. If you could have 100% participation, let's say it's the S&P 500, and you capped it at 10, you could never make more than 10%. If the market went up 10, you started with 100, and the market went up 10%, you'd have 110. In a fixed indexed annuity, if it was 100% participation in that and a 10% cap, you'd have the same 110. Now, that gain becomes principal. It locks in at the end of the year. You can't lose principal in these vehicles. So market goes down 10%. Back in the days, you're at $99,000. Back in the days when we had a 1% floor, and I don't care if you have a 0% floor, that's generally where they are, you'd still be at 110. In this case, we're showing 111. But this is where the drama occurs. When you come back up, you're coming back up from where you left off, not from the bottom. So if the market goes up 5% the next year, you're at 116,655 because you didn't take that loss. Whereas the person coming back from the loss still hasn't made up the distance. That's a 12,705 difference on this illustration. This is not a specific product. It's a conceptual thing. I want you to understand about how fixed index strategies work. Okay, why settle for regaining loss? Okay, this is an important slide. Now, the insurance companies, when they do this, they water it down. They make the strategy look really weak because they don't want to overpromise. They don't want anyone being disappointed. So they weaken the dickens out of it when they display it. And that's what you're going to see here, but I still want you to see it. This is the movement of the market over the years here. Let's see, it looks like this. Okay, so March 2000, the market falls until October 9th, 2002, starts to come back up to October 9th, 2007, and then it drops to March 9th, 2009, and then to December and past, it's soaring. That's the market. That's what you'd have you in the market. Great in the good days. But I want to show you something. If you're in a fixed index strategy, and let's say you're older and you can't take those losses, this is what you'd be experiencing. In those down years where the market is falling, you would just be holding still. That's where the fixed index annuity protection, the protection of a fixed index strategy works. Now, when the market starts to climb again, let's put a cap on it, only so much. In this illustration, which is ridiculous, they're putting a 2% cap. They're just saying if you only made 2% a year in the years that the market went up, and you only did that, but you made money those years, you would have not suffered that loss. You would have climbed slightly to where by the time 2008 came around, you had as much money as the guys at the top of 2008. Just by getting 2% a year in the up years and not suffering the down. So then the market falls off again. And then it comes back up. You're making 2% a year. And by 2014, you're still even with the market with the 2% cap. And I'm going to show you in a minute people that made 20% a year, 17% a year in these strategies. I've got redacted statements I'm going to show you. This 2% is nuts, but it's what they got to put on their literature to make sure they don't overpromise. I will send you this flyer as well. Okay, so anyway, yes, eventually the market beat it because the market continued to soar. We'll see now what that looks like when this blood is done pouring into the street. This is an actual statement. I just want to show you that you're not restricted to 2% gains in these up years. Right here, what you see is you see a 2-year period of market gains. In this case, it was set on a 2-year stretch. So the gains weren't credited till the end of 2 years. From 1st of September 2016 to 1st of September 2018. In that 2-year period, in a fixed index strategy, which could not go backwards, and all of these are different. And the point is, I'm going to give you a number at the end of the call, a way to get in touch with us. All of these function differently. You need to look back and see who you are, what age you are, what's the rest of your portfolio look like to see what is pertinent and the best way to do this. But in this case, this was a particular model that had some fees in it that would supercharge the upside, but still protect against the downside. And you'll see a fee coming out of this. But the bottom line is, in 2 years, this fixed index annuities with limiters on how much you can make in the market made almost 44% over a 2-year period. So this is a client, and it was awarded at the September 2018 for this client. So at September 1st, 2017, the client's account was at $537,000. 1 year later, it was at $755,000 because 44% interest was added to the account. And let's see where the interest amount is. Well, it's the difference between 537 and 755. So that's about $220,000 of interest in a 2-year period on $500,000 going in. Point I'm showing you here is they can earn well. Now, here's another one. That was a friend of mine's client. This is my client. Name's redacted. This is a product. The performance was a 1-year performance, February 2017 to February 2018. This is the statement. Notice what's circled down at the bottom. 17.44% in 1 year. So this was an annuity that started, well, I'll show you the start and the finish, but you'll see we had it in 4 different strategies. This is how much of his money was in each strategy. We went heavy on this one. We thought this would be a winner, and we were right. This one strategy gave him $38,000, almost $39,000 interest, 19.72% in a fixed indexed annuity. Now, can you get them as good anymore? I don't know. You always have to shop rates. As interest rates fall, these are harder to sustain. But once you're in a contract, it can't be worse. Those contracts will hold those levels of performance throughout their period, but the new contracts tend to get watered down a little bit as the Fed keeps dropping interest rates, and they have something to do with the engines in this. I'll explain it all to you when we meet, when you call the number at the end. But the point is, you've got good gains in this. And this is literally, in 1 year, a contract that started at $280,000, and in 1 year, in a fixed index environment with annual lock-in that couldn't be taken away, and made $48,684 and wound up at $326. At the end of that 1 year period, if you're not happy with those kinds of returns, then you deserve to suffer the consequences when the market falls. Other than that, I don't have any really strong feelings on the matter. Hey, look, this is what you need to do. I just wanted to show you that these strategies can work for you. Call 818-434-4946. That's my mobile number, 818-434-4946. You can also email me, bruce@straighttalkwealth.com. That's bruce@straighttalkwealth.com. I do have a special offer. I do have a special offer. Look, if you respond to either of these, and we can sit down and talk a little bit about what your circumstances are and see if this is the appropriate way for you to recover out of these markets and never have a loss again due to the markets dropping, then I'll include this free report called Inflation or Deflation. If you just call and email, you can have this stuff. You can have this for free. Inflation or Deflation, America's Monetary System in Crisis, and How to Plan for It. This will tell you the difference between, does this mean we're going into inflation? Does this mean we're going into deflation? I don't know. They say both. What does it mean? I should buy gold. I should buy properties. What does it all mean? This book has the answers, 45 pages, highly illustrated. And I'm also going to give you this audio CD of my interview with Harry S. Dent called The Great Gold Bust Ahead, and why he's basically saying gold is not a refuge in these times. And there's just all kinds of great stuff. I'd read the topics, but we got to go. Call the number 818-434-4946. Get in touch with me. That's going to hit my mobile, or write Bruce at straighttalkwealth.com. We can look at these strategies. We can look at what's appropriate for you, and we can see what's a fit. Stay some in the market, play the game if you will, but as you get older, you've got to get into preservation mode. I hope you've learned this week, and I hope you learn it going into the future. Older people have to preserve. They can't stay in the game when it falls off and find out 6 months before retirement that it's now going to be 5 years before retirement. Thanks for listening. I know it's a long video. I hope it was informative. That's it. That's how we do it.
Content of Straight Talk Wealth Radio is for educational purposes only. Any discussion of financial products and their features is subject to change without notice. Consult your own tax, legal, or financial advisor as to your specific situation. Secure Financial Services Incorporated, California Insurance License 0E48147.